Tom, welcome to the show. Great to finally have you on. I know we've tried a few times. Everyone's schedule's a bit crazy, and you've both got Pemba T-shirts on. And in matching jackets, but not matching colours. I like it. I like the way you've done that. So, Tom, why don't we kick it off? Tell us what Pemba Capital Partners is.
Sure. Well, thank you very much for having us. So, Pemba Capital Partners, we're a growth investor.
Yep.
So we seek to partner with founders and ambitious management teams to really help drive accelerated growth in the businesses that we invest in. So we're typically dealing with more SME-sized businesses.
Yep.
And really, we try and the way our mindset is to really help try and achieve the specific objectives of the founders and the management teams that we back, and they typically centre around growth, liquidity, succession, ensuring their people will be well looked after, and legacy.
Okay. Now, you said SME. Now, as a recruiter, SME can mean, different things to lots of different people. So what's your definition of an SME business?
Yeah, so probably up to about 20 mil of cash profits.
Yeah, okay. And is that the only measure, or do you measure it on global footprint, size of staff, or is it just you just pin it on that?
From an investment point of view, we look for a minimum of 3 million of profit. So profit is a key metric for us, and then we look to scale that rapidly through what we call a buy and build strategy.
Okay, so you don't mind if it's a huge turnover but small profit, or massive numbers or small numbers, doesn't matter, it's just the profit.
Profit's important. We've got some very clear investment criteria that we look for. So maybe I'll just quickly spin through those.
Go for it.
So we look for, as a growth investor, we look for growing end markets, but with sustainable growth drivers underpinning those. So, for example, drivers and markets that aren't exposed to an economic cycle and are therefore recession resilient.
Yep.
We look for businesses with repeatable, predictable revenue models.
Okay.
End markets with high barriers to entry. And as a proxy, we look at profit margins, high and sustainable profit margins through the cycle. We look for high cash generation and typically fragmented markets which lend themselves to this buy and build or accelerated growth opportunity.
Okay, and how long's Pemba been around now?
It's been around for over 20 years.
Yeah.
And during that time, we've completed over 160 partnership-style investments.
Jeez.
Yeah.
That's a lot. How many is that a year? I'm not going to work that out, no. That's significant. And how long have you been with Pemba?
So personally, I've been with Pemba just shy of 7 years now.
Yep.
I've worked on a number of Pemba's investments during that time, a lot in the tech space.
Yep.
So, we're actually one of the most active investors in the technology sector, completed over 20 tech investments over the last 3 years or so.
Which I'm very aware of, which is why you're here.
One of the reasons why we're here. Prior to Pemba, I've been in the growth investment industry for about 18 years in total. So we're all English by background, so I've spent some time over in the UK. And so I was at a private equity firm called Sovereign Capital in the UK.
Capital, yeah.
There you go. And prior to that, I was in the principal investment team at Macquarie, and prior to that, Deloitte Corporate Finance, both here in Sydney.
Good pedigree, Tom.
Thank you very much.
What about you, Mark? How long have you been at Pemba now?
Yes, actually 14 months, so shorter time than Tom.
Yep.
Really great 14 months it's been. My background, for what it's worth, is just over 20 years providing investment insights into technology companies.
Yep.
As Tom said, there's a strong sort of English accent here today, so you'll detect that the first 12 years of my career was in the UK, providing investment insights, largely into software and services businesses. Okay. I moved down in 2010, and again in investment banking, providing investment insights, largely around the tech arena. And in the last 5 years before joining Pemba, I was fortunate enough to be able to lead 3 IPOs onto the ASX, which were all software and SaaS platforms, one of which was a Pemba asset. And still Pemba has a very strong economic exposure to that asset. And through that process, I was able to meet Tom and the rest of the partners, really got a good cultural feel for the business. Yep. Their investment mandate, which Tom's touched on, was very aligned to how I thought you should think about investing in businesses. And originally we had discussions about potentially coming on board to be a director on a couple of the assets, but the stars aligned and we built a new team over the last 14 months, which I've been leading. So
what's that team called?
The team, Steve's called the Accelerate team.
Yep.
And that Accelerate team really partners really closely with our partner assets, really does 3 things. Firstly, it helps drive the buy and build.
Yep.
so that we can really drive the scale into our partner companies. Secondly, we provide strategic and operational insights. We can maybe dig into that in a short while.
Absolutely.
So we typically sit on the boards of those companies. And then ultimately, we get the assets ready for exit so that our investors can make good returns, but equally importantly, the forthcoming buyer can also make strong returns as well.
Okay, so let's talk about some of that terminology, buy and build, right? So obviously we know what buy and build means. That's pretty obvious. Do you have a specific amount where you are saying, right, if we're going to buy this business, obviously, and we're going to build it, do you have a target for time frame roughly? And I know it will vary, and growth percentage that you're looking at. Is that standard, or does that vary from industry to industry, or how does that work?
Well, no partnership deal is exactly the same, but typically speaking, our partnership period can be anywhere between sort of three to 5 years.
Yep.
We will put a lot of thought right into the outset with the founders of the companies to make sure that buy and build plan is really well thought out and is accretive both strategically and also financially for the business as well. So we spend a lot of time screening the market with the founders of the businesses we partner with. And then we'll have a very intense period of going out and meeting these companies and making sure that they hit the quality thresholds and really fit the investment mandate that Tom talked about.
Earlier.
Maybe just to elaborate a little bit on that. So the way we approach the investment horizon, it's a bit of a different sort of mindset to a lot of other investors out there in the market. So, as I say, we try and help founders and management teams achieve their specific objectives. So our investment horizons usually link to the founders' specific objectives or time horizons, rather than Pembas.
And that's usually an exit, obviously. Is that
usually an exit, but an exit's not always a full exit. So, a great example that we can talk about in a moment is the business that we IPO'd back in April 2019. Yes, it was sort of a realisation event for Pemba, but we still retained 37% of the equity of that business. So it was a partial exit.
So you floated the business, but you're still pretty... Were you the major shareholders still? I would imagine you must be at 37, right? That's pretty significant. All right, cool. Now, before we get on to some of those examples, I have a quick question that I want to know. You both got mountains on your chests.
Yeah.
What's going on with that? Tell me about that.
Go on, you do that one.
Sure. So really, the philosophy that I talked about in terms of being more sort of founder-centric and helping founders achieve their objectives, it's really why we chose the branding that we have and the name Pemba. So Pemba is a common Sherpa name, and the whole philosophy is, like the Sherpa, we are seasoned mountaineers in terms of building businesses. But ultimately, it's not our journey, it's our founders and our management team's journey. And our job is to get them to the summit successfully.
I love that. I love it when companies have a story to their name. So many people don't have stories to their names, and I think it's really important. Cool. All right, Mark, tell me, how do you guys find companies? How do you find these businesses? You touched on earlier that when you scan the market.
That's right.
How do you scan a market?
Well, firstly, we step back really from the noise, and we've looked at what are the key thematic drivers we think that the economy is going to benefit from. And there's really 5 sectors that we play in: technology, education, non-bank financial services, healthcare, and business services. So having then looked upon those sectors and worked out where we think within those sectors are the key thematic drivers, we'll then unpeel the onion a further layer, and we'll go out and screen the market for the companies that we think are really attractive.
Okay.
And then rather than waiting for those companies to come to us, we get out in the market. We're frequently out on the road. We're talking to lots of people and really working out what we think are the high quality businesses. And we're looking for businesses that have got good recurring revenues, good cash generation, have a profit base that we talked about, and most importantly, have a really good growth trajectory.
And then what do? Do you just ring them up? Is that how do you once, say you've identified you've done your scanning and you've come up, I don't know, let's say there's 6 companies, particularly in the education sector for the sake of argument. How do you then approach those 6 companies? You said you don't wait for them to come to you, you get out in the market. How do you do that? Is it events focused? Do you just ring them, or do you go through brokers, or how does that work?
Combination of the former two. So we do make contact. We do have regular events as well. So we're often meeting founders that way. And excuse me, it can take a long time. That sort of
I can imagine.
courtship can be, a very long period of time, and we'll often have conversations that go on for a period of years.
Yep.
It may well be that companies at that point aren't quite ready to partner. As we said earlier, it's the founder's journey, not our journey, and so we're very happy to be patient, to wait until those founders are in a position to potentially do a partnership deal with us.
Yeah, so it's a long-term view. So do you sort of would it be fair to say you make yourselves aware or visible, and then you wait for them to sort of almost take that next step? Is it that kind of sort of subtle little approach?
I think we are very subtle. I think that's right. And it's a combination of the two. It's really spending a lot of time with the founders, giving them confidence about the journey that they can drive themselves, and over time getting more and more confidence to move towards that partnership.
Okay, and one last question on that. What was the last category you said? Did you say business services?
Yes.
What does that mean?
So that would be, we think about that as white-collar business services. So that could be outsourcing-based services, for example.
Yeah, all right, cool. And Tom, so let's say you suddenly have founder goes, you know what, I'm ready. What do they come to you with? I imagine that this is a very, I guess, emotional decision for them, right? And they'll be, let's put it honestly, they're probably petrified, right?
Yeah.
They're bringing someone into their business that is obviously very knowledgeable. That's probably quite confronting in itself. What do you find? What are the typical problems that you have when you get to that stage from, okay, we know who you are, and I'm sure it wouldn't just be you guys, they'd probably know a few, and I'm sure they would court a few people, which is very inappropriate, but they would court a few people. What do you find are the biggest challenges then from getting them there to actually, signing a term sheet?
Yeah, I think it goes back to the approach that we talked about, a while ago. It's about building trust, building rapport, ensuring that they're aware of our partnership approach, because our style is quite different from a lot of others out there in the market.
Yep.
But in terms of their key concerns, it comes no surprise, loss of control.
Yep. Number one.
Entrepreneurs by nature, entrepreneurs for a reason. They're not. They didn't choose to be employees, so having control over their destiny and their business, which is like a baby to many of them.
I always find that analogy weird. I've had 3 businesses. I've never seen any of them like a baby. Anyway, carry on. Sorry.
The next one would be around their people. So the people aren't just names in a spreadsheet. These are individuals that they've hired, they've developed, they've grown. A lot of the times there are family members working in the business. So ensuring their people will be well looked after is really key.
It's always fun, isn't it, when there's family involved?
Right. Yeah. and then the next point is around them understanding how we can add value, because ultimately there's a lot of capital out there and a lot of capital partners, as you mentioned. And arguably, capital's a bit of a commodity. So if I put myself in their shoes, I don't just want money. I want the right partner that's going to help me take the business on the next stage of its growth journey.
Yeah, absolutely. And is there a particular sort of, process that you go through with them, or is it very different with every single one?
It's different with every single one. So as I mentioned, we've completed over 160 of these partnerships.
So I was thinking there must be some trends in there, I guess.
Oh, there are some trends, but we've seen every scenario under the sun, from business owners looking to cash out completely, retire and drink pina coladas on the beach, through to ambitious management teams that want to own the company that they work for. So it really does vary, sort of case by case. Okay.
And Mark, what about, you've been through a lot of different scenarios and companies, and you talked about the UK here and there. Is there a particular challenge that you find? I mean, obviously it's competitive. I'm assuming it's competitive. I've got to be honest, I don't know the capital partner business intimately, but there's a fair few out. In Australia particularly, because you both worked overseas, is it very competitive for you, and is that a massive challenge? Or, you've mentioned that you're slightly different. I'm intrigued to know what your thoughts are on that.
I think we are very differentiated. So I think during that courtship period, I think the founders really get an understanding of what it's like to work with us. I would also say that we have a completely open book on all of the partner investments that we've made.
Yep.
And so any prospective founders, we actively encourage them to speak to and meet up with our founders.
Yep. Okay.
And that's also really important when we think about the tenure of the business. So business is going now for just over 2 decades.
Yep.
And it's really important to speak to businesses that were in the portfolio during, say, for example, the GFC. Yep. Actually what it's like to work with a partner company when times are tough in the economy. And so we're very, very open in that respect. In terms of challenges, you use that word challenge, I would say, thinking now more post when the partnership deal has been completed, probably the biggest challenge is that drive to invest in businesses. A lot of founders, by their very nature, have always been starved of capital, and they've watched, therefore, every dollar that they've spent. Part of being part of our group is really encouraging a sensible investment plan to come through. And we typically always invest in our business. We absolutely invest in those businesses to drive growth. So changing the founder's sort of perspective and mentality about investment is really important.
Without them going wild, right?
Without them going wild, so that's right. There's again, that's the partnership approach, but it's always about adding in key talent to businesses. And obviously we've experienced that with you and your team. We've been able to leverage the relationship to bring in some really good talents to some of our partner companies.
And you and I have talked about this in the past. And I've talked about this a lot on this show. And you mentioned it earlier, Tom. Founders tend to be relatively control freaks to some degree, right? In a healthy way. So bringing in new talent and letting go of certain parts of the business, or even if they've kept their hand in to a little degree, can be a big challenge. So tell me, what else do they get? Other than the capital, what else is, if the founders watching, and there's lots of founders that watch this show.
Yes.
What else do they get from you guys other than capital?
Yep.
What would they expect to sort of receive? And again, I know it will be different, but
absolutely.
Overall.
Significant amount of support is the answer there.
What do you mean by that?
What I mean by that, to extend upon that, is it really starts right from the outset of the relationship, and we'll think holistically about the business. We'll work with the founders to really understand the addressable market, help them understand if there's new products, new services that can be added. We'll help them work out how they can supercharge their growth, and we'll help them look at their resourcing. We will also bring in a cadre of external consultants that have specialisms. We'll help them look at, as you said, the capital structure in the business. We'll look at the cash flows. So really, it's a whole A to Z of that support that's there. But really, we become really friendly and really close to our founders, and we're often sort of talking at the weekend about ideas for the business. So it's very lonely being an entrepreneur and a founder. So to have that partner there is a really powerful thing, I think. Yeah.
Does it take a little while for them to get used to that?
I think
you find that grows throughout the...
Yeah, I think that's right. There's a natural sort of adjustment period to that.
Yeah, absolutely. That's interesting. And you mentioned earlier, I think it was a particular IPO. Is that the one that I know? Was that the one you were dropping on? Should we talk about that as an example? Because I think examples always make it easy for other people to understand.
Yeah, absolutely. Yeah, so the business is ReadyTech. And I know you've worked very closely with Mark and the team there. So maybe a little bit of background. So for those of you who don't know ReadyTech, ReadyTech provides mission-critical software solutions across the education, employment, government and justice sectors. By way of background, so Pemba first invested in ReadyTech back in 2016. At the time, the business was owned roughly sort of 50-50 by two individuals, an older gentleman who'd stepped out of the operations a number of years prior, and then a younger CEO. And obviously, given the different stages of life, there was always a little bit of conflict's probably too strong a word.
I was interested to know what word you were going to pick there.
In terms of how the profits and the cash flow of the business should be utilised. Obviously, the older gentleman was looking to fund his lifestyle, and the younger CEO was looking to reinvest the profits for growth initiatives. So we approached the business, approached the two shareholders, listened very intently in terms of their key objectives, and we were able to structure a transaction or an investment whereby the older guy cashed out 100%. The younger CEO sold down some of his shareholding, a small amount of his shareholding, to de-risk his personal financial situation on consummation of our investment, but really retain a meaningful shareholding, bring on board an experienced growth investor, and then embark on an accelerated growth journey. So in terms of that growth journey, at the point of our investment back in 2016, the business had about 300-ish clients. We worked very closely with Mark and his senior team Many of whom we actually equity incentivized. So the older gentleman had been quite reluctant to cut some of those key people into the equity historically. From our perspective, again, that goes to the partnership nature of Pemba's investments and making sure that we're aligned with the key people in the businesses that we back. So there are a number of individuals that we cut into the equity. We embarked on this accelerated growth journey, and in 2.5 years, we actually IPO'd the business on the Australian Stock Exchange. So in 2019, we were the first private equity-backed IPO, and in fact, the first IPO of scale that year. By that time, the business had grown from about 300 clients to about 3,600. Profits from about 3 mil to just shy of 15 at the point of IPO. And then since the IPO, as I mentioned previously, Pemba retained a very meaningful shareholding. The CEO is still the CEO of the listed company, as you know. All of the senior management team are still key members of the senior management team and benefited from their equity that they were cut into on our deal. And the business is now north of 25 of profits and about 4,600 customers. So very much continued on that growth trajectory.
And seems to continue from what I can see. Yeah. And you mentioned you cut in the key equity members. It's interesting, you do see some founders that are not so keen to do that, although I've noticed there's been a big shift in that in the last few years. Do you do that on all of is that typical for your deals?
Yeah, very, very typical, yeah. Now, what's also quite usual is a number of these people, they don't have huge amounts of capital to invest. So we typically structure it in a way whereby they can effectively generate quite substantial proceeds relative to the equity that they actually invest alongside us.
Yeah, which makes everyone happy.
Absolutely, yeah.
Fantastic. And Mark, you've done a lot of IPOing as well. It's a question that, I'll quote you some facts that I don't know if they're facts that people tell me. People tell me stuff all the time. I was told, I think it was December, that the last quarter of 2020, more companies registered to IPO for 2021 than has ever before happened in Australian history. Is that someone lying to me, or is that true?
No, I think that probably is a reflection of where the cycle was at that time. It's slowed down a little bit over the last couple of months, but there's definitely been over the last few years a significant amount of interest in IPOing. And for some companies, it's absolutely the right step. And for a business like ReadyTech, it was primed for bringing to the public markets. It had all the qualities that you would want to see as an institutional investor, and has continued to do well in public life. You've probably got a lot of founders tuning in to your channels that are thinking about IPO, and for many it will be right, but equally for others, and there is a temptation to try to come to market too early, and we've seen a lot of that occurring over the last few years. And I think founders often underestimate the challenges of being a publicly listed company, whether it be the simple costs of being a publicly listed company, the time constraints, the scrutiny, and the inability to do some of the things that you can do in the private market. So we would always suggest there's another solution to going straight to the IPO, and I think that potentially because in previous years the VC community has been a little bit less developed here than offshore markets, companies have come too quickly to the IPO route. But the great thing about a partnership with Pemba is that you can actually achieve a lot of things that an IPO enables you to do, whether it be to potentially take some capital off the table at the outset. You lock yourself into what can be a very powerful second payday. But more importantly, the overlay of that is that you get that whole support network that we talked about before.
Yeah, absolutely.
So you can really position and scale up the business in the private arena before you actually come to the public markets.
So let's talk a little bit about that. And look, I've seen some. I'm working with some at the moment who we're helping build C-level teams because they're IPOing. I don't think they should be IPOing at all. I think they're way too early. Let's talk about that a little bit, because I think that's a really interesting question that people just don't know. Where do you think, what are the indicators that perhaps someone is ready, and in a very simplistic form? And then to sort of counter onto that, what happens if you do go too early? Because I think it can be horrific, right? It can be absolute car crash and really damage the business, from my understanding. But I'm interested to hear your take on it.
I think that's right, Steve. Maybe we'll go to that part first. I think that really what happens is, and typically it's about sizing, is that businesses just don't get to a size and scale that is large enough to attract a really high quality share register.
Yeah.
So the business will be IPO'd, it will just get over the hurdle, but then it'll be in this almost zombie type state where it can't attract the high quality investors. It's therefore not getting the capital, and then the business becomes starved of capital, so it can't invest in the growth initiative. So it becomes this vicious cycle that you're in.
It's expensive, right, to be listed?
It's extremely expensive, and there's also equally been a trend for some companies coming off the ASX as well, because they get themselves caught in that void that I talked about.
We've worked with some that have delisted to enable them to grow.
That's right.
Which is, like, you kind of think that's counterintuitive. They're delisting so they can grow, isn't it? It's supposed to be the opposite. So
exactly. So it is about timing. It's about choosing the right time. And your question was, what's important? Well, I think it's resilience of business model. It's being able to be of the size and scale where you're generating enough cash flows to be able to both reinvest in your business to drive for growth, but also to attract, as I said, a high quality share register.
Okay, cool. Now let's talk about you guys a little bit more. So Tom, tell me, what have you, 7 years, it's a good innings, what have you enjoyed most about it? Other than the free T-shirts and mountain climbing analogies.
I guess, my passion is working with entrepreneurs, and, what gets me out of bed in the morning every day is I get to, help these founders build great market-leading businesses.
Yep.
So, for me, that's what it's about in terms of growth equity.
Yeah, look, I mean, I can align with that. That's why we did this business as well, because I think the energy of working with founders is very different than the energy of working with more traditional or larger corporate businesses. It's a completely different feeling, I think. Yeah. And it's the blind optimism as well. It kind of fills you with hope in your own life, I think. What about you, Mark? What have you enjoyed most about it?
Probably I'd go to the transition there, where now we're actually really able to help, it's similar, I guess, really able to help founders build something. I love building things, whether it be teams or businesses. And so I guess I've enjoyed two aspects. One, working with the founders as they build out their businesses, but I've also really enjoyed building our Accelerate team and seeing the younger talent in the Pemba business really come through. And we work with some really smart, young, hungry individuals whom are really growing their careers, and that's the part I love.
Okay, that's cool. And what do you think the qualities are of working within your business? What is, other than being good with people?
Yeah, I'd say it's actually a really difficult role to recruit for, because if you think about...
I've never tried.
Maybe we can change
Steering
that.
well clear of it.
It's, if you think about the role of an investor, you've got to, be an originator, so you've got to get out there, you've got to hunt for new opportunities, you've got to, once you've got to be able to win the hearts and the minds of a founder, so you've got to convince that you're credible, you're going to be a good steward of their business, or their baby moving forwards.
Yep.
And then, you've got to be able to run a transaction process. So that could be, the due diligence work streams, the internal approvals process, the external debt raising, if you're bringing third-party debt into the capital structure. And then, you've also got to be a management consultant. You've got to, work with the business post-completion or post-investment to help them deliver on their growth objectives. You've got to be a non-exec director. And then ultimately, when you come to exit, you've got to, got to be a specialist sell-side advisor and master negotiator. So it's actually very difficult to find someone with all those skills. I don't ever want
to work that role. That's the worst job spec ever in terms of, that's a lot of very, that's a real mixed traits. Have you got anything to add to that? Or, I mean, that's a lot of things you're looking for in an individual.
Oh, I think that's right. There's a really diverse set of skills, and then at the overlay of that is the resilience to you talked earlier about how do we find businesses. Naturally, you have a lot of knockbacks, but you have to pick yourself up and keep going. So all of those skills with a very deep pocket of resilience, I would say.
So someone asked me, I did an interview yesterday with a magazine, and they asked me if I believed entrepreneurs were born or whether they grew. So I'm going to ask you guys the same question. Do you think that, equity capital partners, are they grown, or are they born that way with that unusual skill set? And if they're grown, is it a mix of some sort of coming through an unusual career path, or do you think you can come from anywhere?
It's a good question.
I didn't have that one on the prep sheet for you either. So that's just
look, I think you can definitely learn it. I'd say, and I had this conversation with one of our team this morning. I think, the great thing about the Pemba model and the velocity of deal flow and transactions that we do is you do get to see all these different situations. And it's almost a little bit like playing chess.
Yep.
If you've been in a position and playing chess previously, you know how to counter.
Yep.
So I think, it's like anything, the more you do it, the better you get at it. So I think, absolutely it can be learned. I'd say it's harder to learn the softer skills. So the negotiation, the building rapport with founders, the winning the hearts and the mind, the understanding, the subtle clues in terms of body language or use of language.
Yep.
I'd say that's a lot harder.
Yeah, okay. And let's talk about the market. I'm intrigued about the market. So we've just gone through a pandemic, as I'm sure you're both very aware. And the market, from my understanding, was quite heavily flooded towards the end of that with money. And you mentioned earlier that capital was very much a sort of commodity. Is it still like that now, Mark? And where do you think, these things typically go in cycles. Obviously, we don't have a lot of pandemics, but we certainly had downturns. Where do you see that going in the next 12 to 18 months? And I'm not expecting you to predict the world economy, but just, typically based on your experience, how do you see that panning out?
I think it is very buoyant still.
Yep.
And so we're currently deploying our latest fund, and we've got a very good pipeline of opportunities coming through. So there's lots of founders that are wanting to interact with us. So I think there is definitely that buoyancy, which is really good. I think, generally speaking, the economic outlook is pretty constructive over the next 12 to 18 months.
Yeah.
Obviously, everybody's watching the interest rate cycle pretty closely for any signs of inflation, but typically speaking, we think that it's a pretty buoyant outlook. In terms of COVID, what was great about that period for us as a partner investor is that our assets proved really resilient through that time, and it goes back to that initial investment mandate and actually really heavily focused on businesses with strong visibility, recurring revenues and cash flows. So we were really pleased with how our partner assets traversed the way through what was a really, really tough economic period. But
interesting.
Very constructive, Steve, is the answer for the next 12, 18 months.
That's good. I mean, I think you must have had a couple of sleepless nights back, I think, in March and April. I think no one had any clue what happened.
Absolutely.
And you've got a heavy technology bent, obviously, which has really been incredibly resilient and benefited to some degree, if you want to use that word, through the pandemic. I try not to use that word through the pandemic, but okay. Now, lastly, I really want to sort of touch on because we have so many founders that watch this, and a lot of them might be bootstrapping and thinking about this one day. A lot of them might be considering the VC route. There's also this sort of gulf of lack of funding between seed and a Series A or something, or if they bootstrap it to your size. What do you think is the best course of action for a founder if they're not at the stage yet, but their business is growing and perhaps they haven't gone down the VC route, and that when should they start talking to you? And if they are considering going down the VC route rather than perhaps growing it themselves and then coming in with a partner like yourselves, can you go down the VC route and still come to you, or is that something that doesn't happen? Who wants to answer the first question?
You go for that.
You go first.
So the first question, absolutely, they should, if they operate within one of our sectors, and our green-lighted niches, then they should reach out to us and start building that relationship. At the end of the day, we view our job as trying to solve the specific objectives for those founders, and it might be that we have another partner company that they could actually partner with and join, and therefore, even if they're not quite at that size yet, by joining with another organisation that's backed by Pemba, they could actually accelerate their growth journey or help them achieve their legacy objectives.
You do a lot of that?
Absolutely, yeah.
That's awesome. So really, there's no time that's too early.
That's right.
No time that's too early, yeah.
Well, that's interesting. And what about if you've already gone down the VC route? And to be quite clear, the VC route's quite different in terms of it. From my understanding and what I've seen is the funding's there, but the support not so much.
Yeah.
In terms of they're not as invested in the business. It's more of a analytical numbers game. Okay, we believe this business can be successful, so we're going to invest X amount of money in it, and if they reach their next target, then they get the next amount of money, which is very different to what you guys are doing, right? They're just sort of endless growth.
Yep.
Do you see them coming to you? Do they come to you as well? Is that something that you get a lot of?
We do, yeah. We see a lot of VC-backed businesses in our sectors and green-lighted niches. Historically, just given the maturity or lack of maturity of the VC market relative to UK or US, we're usually the first institutional capital onto the register.
Interesting.
But that's not to say that moving forward, given all of the VC money that's sort of awash within the Australian and New Zealand markets, that's not going to change in the future. So, you know, we do come across lots and lots of VC-backed businesses, some fantastic companies out there. We actually maintain our internal database of VC portfolio companies that operate within our sectors.
Yep.
So they're well and truly on our radar.
Okay. And are there any of your companies that you'd like to talk about today, whilst we've got the chance that you think deserve a bit of a shout out, so to speak, that you're really just, I don't know, in love with at the moment?
Well, we're in love with all the partner companies, but I guess there's probably a couple that are worth flagging. We were really pleased earlier in the year with Open Office, which was a local government software and justice software business, which through the tenure during the Pemba partnership really saw a strong acceleration in its recurring revenues. And
what's justice software?
So that's working with the courts and justice.
Right,
so the workflow behind courts and justice systems. Cool. So they work with the Ministry of Justice in the UK, for example. So now that business is really trending very well. Philip Simone, the founder there, has done a great job driving that business.
Cool.
And the other one I'm really excited to spend a lot of time on is a point of sale and payments business, which now through a buy and build over the last 6 months has really now positioned itself as the national champion in terms of point of sale and payments. And so that's a business we're really excited about. And with your question around the economic outlook, one area that is obviously seeing a lot of spend, of course, is hospitality and entertainment. And with the travel restrictions globally, we think Australians are going to continue to spend a lot around entertainment as we come out of this COVID, lockdowns aside, but as we come out of this COVID environment, that's an area that we think is going to do really well. So, yeah, we're really pleased with that asset as well.
Yeah, that's exciting. And how many companies have you got now, did you say, currently? Under you're sort of partnered with?
We're around about 12, aren't we, across the portfolio?
And is that typical?
That will grow. That will grow. Yeah, that will increase as we've now made 2 investments in our latest fund, a healthcare software business with a strong growth outlook in the US, and an insurance premium funding business as well. So we're now actively busy out deploying Fund 2, so that number will definitely grow.
Okay, do you look for, and I know we kind of touched this earlier, but I've seen a massive amount of this, more than I ever dreamt of. And, you know, we've opened a couple of overseas offices because we've seen so many Australian companies going overseas, which is amazing to see. But I've seen a definite trend and desire of Australian companies, both bootstrap ones that are pushing themselves through, or even the VCs who are going, right, we're going to go to the US, or we're going to go to the UK, or we're going to go to Asia. That seems to be happening a lot more than I ever anticipated. Have you seen a similar thing?
Absolutely. So Mark mentioned our most recent investment in the pharma software or healthcare tech business. They're pushing strongly into the US market. We have a couple of other prospective partner companies that we're working with at the moment. We're sort of helping with the strategic planning process, and international expansion is very much on the agenda for all of them.
Yeah, it's exciting. It's good to see, right?
Yep.
Very good to see.
Right.
Yeah, fantastic. Gentlemen, thank you so much for coming on. It's been a pleasure to finally have you on. And look, it sounds like you are going to have a next level hectic 12 months, and I can't wait to see some of the new businesses that you end up sort of investing in. If anyone wants to get in touch with you, the best way, the Pemba website or LinkedIn, or what's the best way to get in touch with you guys?
All of the above, really.
Yeah, all the normal ways, or you can ask me.
Yeah, again, thanks for your help, Steve. It's been great.
Pleasure. Thanks, guys.
Thank you.